This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. This morning, as part of the Financial Repression Authority's ongoing interviews with experts in the area, we have Ronald-Peter Stoeferle with us. I refer our new listeners to other interviews, presentations, articles, and breaking daily news on financial repression at our financialrepressionauthority.com site. Ronnie, welcome, and maybe we can begin by you giving our listeners a brief overview of your background.
Sure. Thank you very much for having me, Gordon. I really appreciate it. I got into financial markets when I was 14 and bought my first stocks. And that moment I kind of got hooked. So I always wanted to study and to work in financial markets. I studied business administration and economics in Vienna. Studied for a while in the US. And graduated and started working at Erste Group here in Vienna, focusing on Asian equities at the beginning. And then through my private investments, I held gold mining stocks that did tremendously well. And then I went to my boss and said, yeah, would it be possible to write a special report about gold? And he said, yeah, go ahead. And yeah, now I already published 8 reports called In Gold We Trust. Those are read all over the world, basically. It's an annual report. And I have to admit, it's not only about gold. I'm seeing gold as not the only answer to the financial questions that we're having. But I think that by understanding gold, you basically understand everything. You understand finance, debt dynamics, monetary history itself, and also very political issues. So therefore, I think that gold as a currency, as a monetary good, is really crucial for our financial system, and therefore making this holistic view that I'm always trying to give is something that readers all over the world appreciate nowadays. And after a few years at Erste Group in Vienna, I quitted my job and joined some gentlemen from Switzerland, and we have set up a new company in Liechtenstein. And now I'm managing one fund that focuses on an investment approach that is based on the Austrian School of Economics. So I'm not only from Austria, but I'm also very much a follower of the Austrian School of Economics that is unfortunately not really appreciated in Austria. It's gaining in popularity all over the world nowadays, but Austria becomes much more socialist from day to day, unfortunately. And we try to educate people about the teachings of Ludwig von Mises, Hayek, Böhm-Bawerk, Menger, and so on. I just released a book about investing based on the Austrian School of Economics, and that's basically it.
Well, you're the ideal person, and we thought so, to talk about this, because we're really looking at what financial repression is so that everybody understands it, and as importantly, what are the solutions investors should take to protect and take advantage of, in fact, of what is going on in it. And we've had a lot of discussions and a lot of posts on the Austrian school's indirect exchange and the methodologies, and hard currencies such as gold and silver are just one element of a strategy to protect yourself, if I can use that. The paper you referred to, I have up here, In Gold We Trust. You said it was an annual one. I strongly recommend to our listeners, and we have a link on Financial Repression Authority to this paper. It's just about, I think, 94, just under 100 pages, and there's a lot of materials in it. Ronnie, I was wondering if you could define what financial repression is to you? How you would easily explain it to people?
It basically means it's a combination of different measures. It basically means that we're seeing a narrowing of the universe of investable assets for investors. So money that should, in a more liberal investment environment, flow into other better investment classes is channeled in a different direction, mostly government bonds, as we know. And the goal of financial repression is an indirect reduction of government debt by manipulating the cost of government debt. And I mean, there are a number of pillars of financial repression. I'm sure that we're going to talk about them. And I think, and I'm writing about financial repression for 4 years now, I think it's getting more and more evident that it's happening, that it's something that happens a bit secretive. So people don't realize that this policy is already going on. And every day there's like tiny news bits confirming my view that financial repression is sort of the solution to get rid of government debt. From my point of view, it's not a solution. It's basically only a transfer of wealth, and therefore I'm highly critical of different pillars of financial repression.
This is a statement from the conclusion you had in that paper on what you thought the outcome would be with financial repression, and clearly it's leading us down a road that you don't believe we should be on, and it's certainly destructive long term to pure classical capitalism.
Absolutely. I mean, there's this term kicking the can further down the road. That's what's happening at the moment, not only in the US, but especially in Euro nowadays. I don't know if your listeners, I think they're mostly from the US, but what's happening in the Eurozone at the moment, I think that's a perfect example of financial repression. So I've added also a couple of charts showing the level of government debt compared 2007 versus 2013, and we can see that it rose significantly. So since 2007, government debt rose by roughly 40%, and I think if the next crisis comes up, and it's only a matter of time, I think that the government and central bankers, they are running out of bullets, because what can they do compared to 2008? It's impossible to lower interest rates. It's impossible to do big Keynesian stimulus projects. I don't know if quantitative easing, another round of quantitative easing, will work again. So we're seeing this marginal utility of further debt is decreasing significantly. So I'm really curious to see what's going to happen if the next crisis really comes up. And I think it's only a matter of time. But in such an environment, I'm regarding gold as some sort of an insurance. Therefore I'm for the longer term, I'm very, very relaxed about the price of gold, for example.
It's hard to see that the solution to too much debt is in fact to create more debt, and as you clearly point out, the utility, the marginal utility of more debt is now at the point where it might even be negative. Ever mind, it's not in fact, other than creating somewhat still. Increasing asset prices, though I would argue that they're starting to level off here. What's happening is, you can create more liquidity, but liquidity is not wealth. Liquidity is not collateral, and debt liquidity only comes through credit into debt if there's collateral. And right now, the collateral problems are so overextended with things like rehypothecation that more debt is a real problem. And especially when the United States, where the bond market is pretty well controlled now, are dominated by the Fed's purchasing as it sucks out more collateral, which has become a big problem. Now, Ronnie, what kinds of examples can you give us in Europe or in fact anywhere around the world, of financial repression today? Because as you point out, we're seeing so many examples ourselves that we actually went to a new dedicated site called the Financial Repression Authority, because we said there's just so much on a daily basis. And then what we're finding is even the posts that we put on there, sorting through them. Because once you understand what's going on and you clearly start to focus on it, it becomes, you understand the magnitude of what's happening.
I totally agree. I think we're seeing examples all over the world. For example, in the US, there are discussions about exit fees on bond funds. I think that's basically a fact nowadays. So we're already seeing that this is happening, and this is quite a huge market. I mean, it's 10 trillion US dollars in corporate bonds. In Italy, we have seen taxes for cross-money transfers at a rate of 20%. And in Poland, basically, and I think that's one of the kind of most ironic examples, we have seen that the government had some problems because there's an automatically implemented legislation that forces the government to consolidate the budget as soon as debt to GDP reaches 55%. So what did the Polish do? They said, okay, we will make a sort of an expropriation of private pension funds, mostly from foreign pension funds like AXA, ING, and Generali. And we said, okay, we kind of confiscate your government bonds and to bring down total debt to GDP. And they really bluntly said, the finance minister said, that this increases the potential for the government to run up additional debt. So at the end, the investor of these pension funds has to pay the bill. And I think that's one of the most drastic examples. Of course, we're seeing a lot of, I think politicians are really creative when it comes to inventing new taxes. We're seeing a very widespread discussion all over Europe about wealth taxes. So tax the millionaires because they already got so much to take from. On the other hand, we should not forget that this also harms capital creation. And I think the most severe consequence of financial repression is negative real interest rates. At the moment, if you got a savings account in Austria, for example, I think, I don't know what the rates are, roughly 0.002%, so barely nothing. Deduct inflation from it, and it's negative. So for capital formation, for increasing prosperity and wealth of a society, you need savings. We cannot consume ourselves into prosperity. So I think this is the most significant consequence of financial repression. And my dad is from southern Germany. It's called Schwaben, and they are very famous for being for their attitude when it comes to saving. And for them, it's really normal to save money and not to buy something that you cannot afford. But this is the consequence that we're seeing now. We're seeing real estate bubbles all over Europe. We're seeing massive asset price inflation because of negative real interest rates. And that's my call. We will see consumer price inflation rising significantly because central bankers and politicians, they do not understand the dynamics of inflation. They think they can, regulate it like a thermostat or anything, but it's not like that. You can say, okay, I'll print so much money, and then we will see so much growth in GDP and so much inflation. That's not going to work out. We're already seeing that inflation is cropping up in many areas, and I think that widespread consumer inflation, basically a stagflation, a bit like in the 70s, will be the scenario going forward.
Yeah, they think they can adjust it, as you say, like a thermostat up and down when you have it, but it's not that at all. Once genie is out of the bottle on inflation. It's a monster, and will bring a country right to its most countries right to its knees trying to fight it once it's out. And that's what's so one of the things that's really dangerous about it. But you're making really a number of very good points here, Ronnie. One of them is, in my opinion, it's destroying, for a sustained period of time with financial repression, it's destroying capitalism. And that is, as you say, capitalism is about savings, and savings being reinvested into quality investments that then create savings and create wealth. And it's that savings that is really wealth. Well, what happens when we're not doing that anymore. We're printing, we're creating liquidity, and therefore what we're to create consumption. So we're creating credit that's replacing capitalism. It's becoming consumption. And consumption takes away from savings. In the United States, it's 70% consumption and government growing. It takes away savings, which robs capital investments, and that's the problem. And it's not that there's not money out there, but there's no wealth to secure the collateral with it. And you get a death spiral, and then you get aggregate demand starting to wind down as real disposable incomes shrink, which is clearly happening in most of the developed countries. Would you agree with what you said?
Totally. Hayek wrote about it already a couple of decades ago on The Road to Serfdom, and I think there's only two ways: it's socialism or it's capitalism. You cannot have something in between, and that in the moment we're clearly going into the direction of socialism. For example, here in Austria, again, the states, the government is responsible for roughly 50% of our GDP. That's the trend more or less in every developed country. So I think a very interesting like anecdotal evidence that I'm having. The whole libertarian movement and followers of the Austrian School of Economics, they're really big nowadays in Eastern Europe, former communist countries, because they know how socialism feels, and therefore their interest in free market ideas is much bigger than in countries here like in the Western world, where we're profiting from the government, and where we kind of forgot how real capitalism really works.
You see, you're right on, Ronnie, and capitalism, it's basically because of competition, and it's the free exchange of products and services between people. It has price discovery. It has value that's in it. So what you get is you get more for less in a healthy capitalist society. What happens as you get more central planning, more control, more rules, more regulatories in there, and I'm not saying you don't need some. What happens is, and you're moving towards socialism, you get less for more. And the reason that you start to get less for more is the capitalist system starts to move through stages. I believe we're in one of crony capitalism, where the government becomes a larger and larger element, more dependencies on it, therefore consuming more of that savings that we just talked about, which is getting scarcer. So corporations start to feed off the government in a bigger and bigger way, because it reduces their risk, regulatory arbitrage, etc. And so so then you get more for less, and then eventually starts to lead to, as you say, social. And there's some very ugly words that can be used to describe the marriage of corporations and government that we don't use in conversation. But I think Mussolini called it fascism.
Yeah,
potentially.
Totally.
I'm not saying we're there yet. I'm just saying that's the danger.
Absolutely, I agree, unfortunately. But on the other hand, we also have to say that capital will always go where it's welcome and stay where it's well treated.
Always.
So I think we're seeing, for example, lots of businessmen here in Europe moving their companies or relocating their families to Asia, for example, especially to Singapore, to Hong Kong, and so on. There's quite a lot going on in Dubai, in Qatar, and so on. So I think the people that already kind of feel what will happen and anticipate what's going to happen, those are mostly entrepreneurial people, and they're kind of leaving. It's a bit like in Ayn Rand's Atlas Shrugged. It feels quite similar,
For
unfortunately.
those who haven't read the book, and I read it as a young man, and I believe I'm older than you, they need to go. You need to read it. It might be a real wake-up call because it feels like, as Yogi Bear says, it's deja vu all over again from that book. As a noted Austrian, Ronnie, can you tell our listeners what an Austrian solution to this kind of money printing, increasing of liquidity, not where it leads, but what's the investor to do about it?
I think a very Austrian approach would be laissez-faire. Just do nothing, let the system cleanse itself. That's going to be really tough. That's going to be like cold turkey for a drug addict or an alcoholic. But after a few years, probably, we would be better off. I think that too big to fail, this is a sentence that cannot exist in real capitalism. So I think normally within a crisis, what should happen is that we should decorrelate. So we should make the system more anti-fragile, as Nassim Taleb would call it. But what's happening now compared to 2008 is the correlation between the different financial market participants and the interdependency is even bigger now than 2008, and that's what kind of scares me. As an investor, I think it's a really tough decision. I don't think that gold is the answer to all our questions. I wouldn't call myself a radical gold bug. From my point of view, gold is money. It has always been money. And I think we're seeing some sort of a remonetization going on, especially with China and Russia, this whole geopolitical picture that is developing at the moment. I think that you have to be really cautious when it comes to junk bonds, high yields. I think this is a massive bubble that we're seeing. I think European government bonds, the risk-reward ratio is ridiculous. I think the stock market is, I don't think it's a huge bubble, but I think it's kind of priced to perfection. So I think we really have to be cautious, and if I can make the comparison with a party, I think that it's already 3 a.m. in the morning, and it's a bit time to leave the party now, or make your way. So there's nothing to win anymore, and gotta be cautious in this environment that is mostly dependent on political interventions. We should not forget that basically now what financial market participants are doing is they try to anticipate what the Fed and what the ECB and so on will do next. So last year, for example, it was all about tapering. When will it start? Will it be 10 or 15 billion a month? That was the big thing. I mean, that already shows us how sick and how fragile the whole system is. So I think you have to invest very actively. That's what we're doing in our fund, for example. We're investing actively between inflation and deflation, because those are two massive forces pushing against each other at the moment. And I think this buy and hold approach that worked pretty well for the last decades, I think that's kind of obsolete in this environment.
Could you explain a little bit more of this tug-of-war between inflation and deflation that you see? And I know you've written about. That's we call it monetary tectonics. So inflation and deflation are like tectonic plates pushing against each other. We should not forget that the natural cleansing of the system would be highly deflationary. So we would see debt reduction, for example. We would see that we would see some sort of balance sheet deleveraging. We are already seeing very sluggish credit growth, and that's a main factor. Central bankers, they want to push credit growth again, but it's really tough because of regulation and so on, because of very high demand to hold money. Monetarists would call it a low velocity of money. So there are massive deflationary forces, but
Now, we all know that deflation is something positive. We're seeing it in electronics, for example. Yeah, computers are getting cheaper and more powerful from month to month. So, natural deflation, price deflation, is something positive and it's something normal in capitalism. However, within our monetary system, within a fractional reserve banking system, we cannot allow deflation to have monetary deflation, because within a very short time, banks especially and heavy over-levered players would collapse. That's basically it, and therefore I think that this deflationary forces have to be compensated with inflationary forces, and that's zero interest rate policy. We're already seeing it. Communications policy, quantitative easing, currency wars. I mean, at the moment, Europe, they're doing everything to drive the euro lower, because that makes imports more expensive. We're importing inflation, and this should kind of solve our problem. But reading about financial history and monetary history, there is no empirical evidence that debasing a currency leads to prosperity and to wealth. So all the hard currency countries in Europe, for example, Switzerland, Germany, and also Austria, they are doing much better than the countries that on a constant basis just devalued their currencies, like Italy, like Spain, and so on. So I think to sum it up, there are massive deflationary forces. We cannot afford deflation within our monetary system, unfortunately. So they will do everything to avoid this natural deflation, and at the end, at some point, it will become highly inflationary.
We have more deflationary, at least in the developed world, in front of us, shorter term. As the impairment of assets and loans impact in collateral values, but the reaction, sustained increases in balance sheet, which will exactly lead to higher inflation and hyperinflation. Remembering, to me, hyperinflation is a currency event about the current people losing faith, and faith and sentiment is something that can change very, very quickly. And hyperinflation. Yeah. The 52 examples that I've studied, it happens very, very quickly, and the destruction that it does is measured in weeks, months, not in years. It happens that quickly. Last question, Ronnie. We got a break. Time goes by. There's so much to talk about here. A lot of our listeners believe quite heavily in the gold and silver as a currency, as an investment, but their concern and their trouble is that they believe the moment it starts more and much more than it already has. I would agree. I believe that will happen at some point. The problem is that the governments will be, again, very repressive to the point of taxation, of penalties for those that hold gold and silver. What are your views on that, and what can they do about
that? I think at the moment, gold is still something very contrarian. It's definitely not mainstream in the Western world, at least. Yeah, that's different in China and in India. But here in Austria and probably also in the US, I don't know the exact percentage, but if it's like 3 to maximum 7 or 10% of private individuals holding gold, that's already, I think that's quite an accurate estimate. So I think if gold will eventually hit new all-time highs, if there's some sort of a gold mania happening, and every trend ends in euphoria and in a trend acceleration, then perhaps there will something be like high taxation and so on. But we should not forget that this is much easier for ETFs, for example. Taxing physical gold is definitely a bit more difficult, and what we're recommending is diversification, also from a geopolitical So it's a friend of mine, he calls it the dog's bone strategy. Do not put all your dog's bones in one place. Spread it out, and that's probably a good recommendation. But as I've said at the beginning, governments can become really creative when the hits the fan. So I think that's unfortunately something that we will have to anticipate. But going forward, I think for the short to midterm, I don't expect any confiscation or anything. For example, in Europe, the Philharmonic coin is legal tender, so you can pay with golden Philharmonic coins here in Austria. I mean, the nominal value is much lower than the market value, but still. There is a very long tradition of people handing out gold as a gift, for example. For babies, they always get gold and silver coins. So I think that it really would have to become very severe before such drastic measures will be implemented. But I definitely cannot rule it out.
So, but there's a fair bit of time between now and when that actually happens. Aware, paying attention, they should be enough time to react or to do something possibly. You got a break, comments or views you'd like to share with our
listeners? No, not really. I think it's a very very challenging time. I advise people to read a bit about the Austrian School of Economics. I think that the main thing, you mentioned hyperinflation before, that it's sort of also a psychological thing. And the beauty of the Austrian school is that they are not making very sophisticated models or calculations, because the Austrian School of Economics was founded during a time when hyperinflation, world wars, were quite normal. So they really knew how to think about the big picture, and not like the mainstream economists nowadays. If GDP growth will be 0.5% or 0.6%, yeah, and at the end, I mean, the estimates are wrong anyway. So I think that the Austrian School of Economics really gives you very good guidelines in this crisis, to understand the crisis, to anticipate what might happen, how everything could turn out. And I think, therefore, yeah, just read about it. The internet is a treasure chest full of information about the Austrian school, and that's basically
how can our listeners find out more about yourself, your work, your investments, and the things that you're involved with?
Basically just visit our website. It's incrementum.li, which stands for Liechtenstein. We've got all our reports on the webpage in German and in English. We've got our interviews on the webpage. We are publishing quite a lot of research, a chart book, the gold report, special reports. So, just visit the webpage and have a look.
Ronnie, thank you very much for your time.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.